So what I would like to share on and build on what Deepa has shared, I guess, is a little bit more granularity and insights into our big stock market, because it's a very interesting one. We have our benchmark index here. So like the Nifty, we have our Straits Times index, and that represents close to 60% of the total market cap of all stocks listed in Singapore. It's built, this index benchmark, it has a 55-year history. It's built with some of the world's strongest banks, businesses with economic foundations that actually span 3 centuries, and it has significant Asia-Pacific connections. So much so that, like our trade-centered economy, close to half the revenue associated with the Straits Times Index in its weighted form is generated in countries outside of Singapore, mostly within the Asia-Pacific region, which makes us at this index actually rank as one of the world's most diversified global stock benchmarks. The APAC ex Singapore revenue associated with the STI is mostly reported to ASEAN, China, and Hong Kong. And this is a very logical relationship, considering that Singapore's ASEAN neighbours account for close to 30% of our exports, while China accounts for 50% of our exports, and Hong Kong less than 15%, or between 10 and 15% of exports. But I think exemplifying the unique geographical reach of the STI, our 3 strongest constituents so far this year have been, number 1, a utility company with assets in Singapore and India, a China-based shipbuilder, and an automobile distributor in Indonesia. The last FY saw this China-based shipbuilder, Yangtze Shipbuilding, report 80% of its revenue to both China and Taiwan. Sembcorp Industries had reported 60% of its revenue to Singapore, 20% of its revenue to India, and Jardine Cycle & Carriage reported 90% of its revenue to Indonesia. And as I said, these have been the 3 strongest STI stocks so far this year. And that significant regional reach of the STI constituents, it does provide this economic foundation for a very competitive performance of the Straits Times Index. And that also parallels how the health of the really big external environment also has a significant impact on the Singapore economy. So the STI, with the impact, I guess, of the constituent overlap, it's naturally more correlated to the FTSE ASEAN All Share Index, more so than the broader Asia Pacific index, as shown in the middle far right chart. However, I guess despite the challenges of the past 5 years, the STI has kept pace with the FTSE Asia Pacific index, while at the same time benefited from the comparative strength of the Singapore dollar that Deepa touched on. And this year actually marked 20 years since our first STI ETF was listed for trading, and that ETF has generated an average annualized total return of 6.3% since its inception. For the first 7 months of this year, the STI generated a 5% total return, and that ranked as the world's most defensive developed economy benchmark for the 7 months, with the FTSE Developed Index basically generating a decline of 13%. And that defensive marginal return of the STI, it was also attributed, I guess, to the decline of technology stocks, which command a much larger sector weight in the bigger global benchmarks. But as you can see in the STI, it is majority weighted to banks, real estate, and industrial goods and services, with the STI's 1 technology stock, Venture Corporation, kind of included in the industrial goods and service categorizations that FTSE and ICB employ. So what's been happening in our market from a broader thematic, I guess, perspective? On a day-to-day basis, we have around 1.3 billion Sing dollars of stocks trading hands. And I guess in addition to the diverse regional revenues that we discussed in that slide just now, is that there's also significant diversity beyond the STI across various sectors and subsectors of the stocks that make up our stock market. So the overall economic outlook for Singapore and services very much depends on how momentum in services and how we can regionally sustain the continued reopening momentum. So just as services are a key cornerstone of the Singapore economy, they are very well represented in the various sectors that make up the Straits Times Index and the broader stock market. So we have relevance in banks, consumer subsectors, broader financial services, healthcare services. There are a number of industrial subsectors that are focused on services, real estate, technology, and telecommunications. So overall, services make up 70% of Singapore's GDP, and these services producing industries, they have expanded at more than 4% year on year for the first 2 quarters of this year, following 5% to 6% growth in the 2021 year. Manufacturing, it makes up around 20% of Singapore's GDP, but it also threads through to a number of these sectors as well, such as industrials, technology, healthcare, consumer non-cyclicals, and of course, materials and resources. Now, apart from having this strong economic relevance across our broad stock market, when key trends really take hold of markets, it does impact our day-to-day turnover composition. For instance, the impact of the Ukraine crisis exacerbating the gains of Singapore's energy stocks, it saw these stocks contribute 2% of our day-to-day turnover, but that's 4 times the impact that those stocks have in the overall market cap of Singapore's stock market. So that was a key highlight we saw in the first half of this year in terms of the turnover participation in the energy stocks. Looking forward to the remainder of the year, the IMF really maintained that Singapore's recovery is one of the strongest advanced economies in the recovery process, with overall activity at the end of last year having surpassed pre-COVID levels. And the IMF have also noted that the outlook for Singapore is a continued broader recovery across sectors, with growth this year projected to be around 4%, driven by, of course, the pent-up demand as the economy continues to reopen. Now, I want to focus on this biggest part of our stock market cap, which is banks, which make up 1/5 of our total market capitalization, but they make up over 1/4 of the day-to-day turnover. And it's very topical because these banks are reporting their first half results. 2 have already reported, 1 more is to report tomorrow morning. So together, DBS, OCBC, and UOB comprise 45% of the STI, while making up only around 5% of the FTSE Developed Index. Banks have been a lot more defensive than technology stocks this year. Hence, that's one of the key reasons why the STI has outpaced big global benchmarks. Banks which borrow short and lend long, they maintain positive correlations in their net interest income to US interest rates, with net interest margins largely determined by the average rate that is paid on their liabilities versus the average rate that they receive on the assets. And that contributes to net interest income along with the size of their loan books. So as you can see in this mid chart, this lower mid chart here, UOB, one of the 3, maintained a 1.6% net interest margin in the first half of this year. And that was determined by the average rate paid of 0.55% on its interest rate exposures, which include customer deposits, and the receipt of an average 2.1% rate received on the interest rate bearing assets, which of course include customer loans. So we are in an environment in Singapore of rising interest rates. Our SORA 1-month compounded rate has moved from 0.2% at the end of last year to up to 1% at the end of June, and is currently at around 1.8%. Singapore banks typically follow this rate for home loan packages. If DBS actually reports tomorrow morning a net interest income that is comparable, at least, with what it reported for the first quarter of this year, the combined net interest income of the trio, DBS, OCBC, and UOB, will actually beat this high, this third quarter of 2019, September 2019 high of 5.745 billion. And that would represent the 7th consecutive quarter of net interest income growth. So as I said, if based on the net interest income of OCBC and UOB, if DBS can at least maintain the same net interest income, we will see net interest income at a high for the bank trio in the second quarter of this year. Now, UOB and OCBC, they have reported loan growth of 8% year on year, They've conveyed confidence in their outlooks. Both expect loan growth in the mid-single digits for the remainder of the year. The higher net interest margins and loan growth has seen basically this net interest income growth offset much of the headwind impact that we've seen in the slowing growth for non-interest income. So OCBC's second quarter non-interest income, it was up 6% from a year ago, whereas UOB's non-interest income was comparable with where it was a year ago. That's for the second quarter of this year. Now, since the end of 2019, if you look at the performance of the trio, they've actually averaged 25% total return versus 6% for their regional peers and their global peers. You can see total returns have been pretty similar with so much sector-driven trends globally. A lot of banks across the world basically did move in a very similar formation, but we have seen enough outperformance from, as we said, from our trio of banks that they have outperformed globally and regionally. But at the same time, the valuations are not too stretched in that their trio actually average price book ratios of 1.2 times, it's a 20% premium to book value, versus global peers, which are trading at a 10% premium to the book value, even though this trio have performed 25% total returns versus the 6% returns for their competitors since the end of 2019. Now, during these earnings week, we also do see pickups in some of the structured product trading on the banks through the DLCs and the structured warrants as opportunist investors do trade the broader reactions to these results. I should also mention that the trio are basically ranking among the 10 largest weights of the FTSE developed APAC ex-Japan Sustainable Yield Index, which tilts to the financial and operating strength of stocks, particularly looking at their strength of the balance sheets and their ability to generate cash flow, more so than a high dividend yield per se. So these trio of banks, DBS, OCBC, and UOB, do consistently rank among the 10 biggest stocks, 10 biggest weights of that index. So overall, as I've said, DBS reports tomorrow morning. OCBC has seen a 28% year-on-year increase in net profit for the second quarter. UOB reported 11% net profit growth. The banks see the credit costs at the low end of guidance. UOB still sees a credit cost of 25 basis points. What the OCBC CEO did note today, that the overall economic growth in its key markets is expected to remain positive this year, but at a slower pace due to the heightened headwinds in the operating environment. Our banks are very well funded, and Ms. Wong also added that the bank has this diversified earnings base, strong capital and funding and liquidity, which allows it to have the flexibility to navigate some of these uncertainties and still pursue strategic growth. The other biggest part of our STI, and this is my final slide, is of course the real estate investment trust. So after the banks, REITs make up 13% of the STI, making it's the second biggest segment of the STI. Since 2002, in July, we've grown to be one of the world's largest REIT and property trust markets. Currently, we have as many as 17 of the 40 or so trusts listed on the exchange, exclusively investing in property assets outside of Singapore, such as Ascendus India Trust. With 20 of the trusts invest in properties in both Singapore and outside Singapore, with the remaining 3 REITs investing purely in Singapore. It includes as many as 10 trusts with properties in China, 8 REITs with properties in Japan, and 6 REITs with properties in Malaysia. And now, I guess with over 80% of these trusts basically owning and managing assets from Asia Pacific, basically across Asia Pacific, the United States and Europe, we are one of the most international REIT markets across the world. They are also very highly diversified across property types. So you have a nice balance of REITs that are investing across retail, industrial, office, and hospitality properties, in addition to multiple REITs that have been investing in healthcare related properties and as well as data centers as well. So reopening has been a big overarching theme for this sector in the first half of this year. It's also continued to attract its fair share of investor activity. So the sector represents around, well, a little bit more than 10% of our total market cap, but it makes up double that, 20% of our day-to-day turnover. And the significant reopening theme has seen 4 of the 5 stapled hospitality trusts that are listed in Singapore rank among the 10 trusts that have basically attracted the highest net institutional inflows for the first half of this year. And those 5 hospitality trusts overall averaged 17% total returns for the first half of last year. Now, despite the backdrop of increasing interest rates, the S-REIT sector does maintain an average dividend yield of 6.6%. That's still some more than 250 basis points higher than our Singapore government 10-year bond yields. And furthermore, this sector does appear to have controlled debt levels. Basically, your REITs on our aggregate have secured around 75% of their borrowings on fixed rates. And the average gearing ratio of the REITs is at around 37%, which is lower than the regulatory limit of 50%. There's been a clear industry drive within the REIT sector this year and last year to make acquisitions, to divest, to recycle properties, basically strategic initiatives to increase unit holder value. And we saw close to half of our REITs last year announce asset acquisitions that were valued at more than 12 billion Singapore dollars, with that asset drive continuing in the first half of this year. So on the growth front, last month marked 20 years since we began listing REITs in Singapore. Capita More Trust was that REIT that listed. It came to the market 20 years ago with a $900 million portfolio of 3 properties. That portfolio value is now in excess of 20 billion Sing dollars, and it has paid investors on average 10% annualized total returns over those 20 years. So on the whole, I guess global REITs, they do have a track record of being defensive in nature, and the 800 or so S-REITs, the 800 or so REITs that are listed across the world have performed comparatively well in terms of yield and volatility and net asset value over the last 10 years, which has basically spanned much more, I guess, many broad market ups and downs, of course, including interest rate cycles. So that's in essence my part of it. As I said, the STI maintains a ranking as the strongest developed stock benchmark so far in the year to date. Year to date, it's a 6% total return. FTSE Developed Index is still down 13%. Beyond the benchmark, however, there have been diversified performances across the multiple sectors and industries that make up our broader local stock market. And I would love the opportunity in the year ahead to be able to share a little bit more on each of these sectors and industries that, as we said, aren't just Singapore focused, but very, very regional focused, and some of the most exciting thematics that you might come across in Asia Pacific. There's a good chance we have a stock relevant to that. Thank you so much.